Okay, let's look at the calendar for a second. It is February 3rd, 2026.
2026? Wow.
And if you've been anywhere near Washington, D.C. this week, or frankly, just scrolling through financial Twitter, you know the vibe has shifted.
Hmm.
It is not the usual partisan bickering. It's not the gridlock we're all so used to. There is a real buzz in the air.
You could feel it.
We are watching the Senate Banking Committee take a step this week that I think historians are going to look back on.
It really does feel different this time. For the last few years, the whole conversation around digital assets was, well, it was hypothetical. It was all what if and maybe someday.
Right.
This week, it feels like the waiting game is finally over. We're moving from theory into, actual reality.
Exactly. And we're specifically talking about the Clarity Act. But if we just look at that one bill, I feel like we miss the forest for the trees.
You do.
To really get why this moment in February 2026 is so critical, we have to rewind the tape. We need to go back about 6 months, don't we?
We do. We have to go back to July 2025. In the industry, they still call it Crypto Week.
Which sounds like a bit of a marketing slogan.
It does.
But it was a legitimate legislative sprint. The House of Representatives just cleared the decks. They passed a whole flurry of bills in just a few days.
It felt like a sprint to the finish line.
But, and this is the key context for today, passing bills in the House is one thing. The Senate, that is where legislation usually goes to die.
Or at least where it goes to hibernate. The House is the sprint. The Senate is the marathon. And getting the Senate to actually finalize rules for the entire digital economy, that takes a level of nitty-gritty negotiation that lasts for months.
And that is exactly where we are now. The sprint is over, the marathon's in the final mile, and you can feel the tension.
The sweat is real.
So our mission for this deep dive is to unpack this whole landscape. We're not just looking at one bill, we're looking at a trilogy of legislation that is reshaping money and the internet.
It really is a trilogy. And like any good trilogy, the order matters. You have three distinct pillars here. First, you have the Genius Act, which is already the law of the land. That's your foundation. Then you have the Clarity Act, which is the main event happening this week. That's the market structure.
You have a third.
And finally, you have the Anti-CBDC Surveillance State Act, which is, that's the ideological battleground.
I appreciate that breakdown. Looking through the source material, the overwhelming feeling I get isn't just excitement, it's relief. There's this sense of, finally, there are rules of the road. We spent years watching chaos. The documents explicitly mention the ghost of FTX. That trauma is still in the room.
It is, and that's the shift we're seeing. We're moving from a period of, cautious observation, where regulators just watched and occasionally sued people after the fact.
Right, after damage is done.
To active legislative engagement. The U.S. government is finally deciding it wants a say in how the future of money is built rather than just reacting to disasters.
So let's start with that foundation, the one that's already in the books, the Genius Act.
The Guiding and Establishing National Innovation for U.S. Stablecoins Act.
DC and their acronyms. Someone clearly worked very hard to make that spell genius.
They do love a good backronym.
Yeah.
But despite the flashy name, this is serious legislation. It was signed into law by President Trump back in July during that crypto week.
And we have to start here, even though it's old news.
We have to, because it sets the stage for everything else.
Okay, so why stablecoins? Why was that the first domino to fall?
Because stablecoins are the plumbing. They're the backbone of the entire crypto economy.
How so?
Well, think about the market. You have these volatile assets like Bitcoin or Ethereum. They swing up and down by 5–10% a day.
Wild swings.
Then you have the U.S. dollar, which is stable but, functionally slow in a digital context. Stablecoins bridge that gap. They offer the speed of the blockchain instant settlement 24/7 with the stability of the dollar.
So they're the oil in the engine.
Exactly. They're used for trading, for lending, for payments. Almost everything in the crypto ecosystem runs on them.
Yeah.
But before this act, it was the Wild West. You had no guarantee that the dollar on your screen was actually backed by a real dollar in a bank.
And that's what the Genius Act fixed. The real aha moment here is the reserve requirement.
It's the death of the trust me era. The law mandates a one-to-one reserve requirement. If you issue a stablecoin in the U.S., you must hold 100% reserves in safe assets.
So we're talking actual U.S. dollars or short-term treasury bills.
That's right. And this specifically targets those algorithmic stablecoins we saw in the past.
The ones backed by, what, math and good vibes.
And we all saw how that ended. Those are effectively gone under this framework. You remember the crashes where stablecoins went to zero because the algorithm failed?
Of course.
This law is designed to stop that cold. If you issue a token worth $1, you need $1 in the vault, period.
It's not just about having the money, though. It's about proving you have it.
Correct. The transparency requirements are incredibly strict. Issuers have to provide monthly disclosures of exactly what is in the bank. And these aren't just, self-attestations.
They need audits.
They require independent audits. Plus, and this is a massive win for the consumer, in case of insolvency, if the issuer goes bust, stablecoin holders have priority over other creditors.
That is huge. So if the company sinks, the users get their money out first. That feels like a direct response to those bankruptcies we saw where customers were last in line.
It's a direct lesson learned. But what I find most fascinating here isn't just the financial mechanics, it's the politics.
The voting numbers were pretty striking.
I mean, in a climate where D.C. can't agree on what to order for lunch, the Senate passed this 68-30. The House passed it 308-122.
That's a landslide.
It's overwhelming bipartisan consensus. It signals that both sides of the aisle realize something crucial. If stablecoins are going to exist, and they clearly are, the U.S. should make sure they reinforce the U.S. dollar, not threaten it.
So it's a geopolitical play, almost. We want the digital currency of the world to still be a digital dollar, even if it's issued by a private company.
That is absolutely the subtext. But remember, stablecoins are just the payment layer. That's the boring, reliable plumbing.
Which brings us to the exciting stuff, the main event happening right now, the Clarity Act.
The Digital Asset Market Clarity Act. This is what's on the table in the Senate Banking Committee this week.
Okay, so the Genius Act fixed the plumbing. What is Clarity trying to fix?
It's trying to fix the turf war. For years, we have had this paralyzed battle between the SEC, the Securities and Exchange Commission, and the CFTC.
The Commodity Futures Trading Commission.
Exactly.
And this is that classic, is it a security or is it a commodity debate? For anyone listening who might not be a securities lawyer, why does that distinction matter so much?
It matters because the rules are totally different. The SEC is a disclosure-based regulator designed for things like, Apple stock or bonds.
Centralized companies raising money.
Right, where you rely on a management team to make you rich. The CFTC regulates markets like wheat, oil, and gold commodities, where price is set by supply and demand, not by a single CEO.
And because nobody knew the answer for crypto assets, businesses were just leaving.
They were fleeing. They were going to Singapore, Dubai, London. The ambiguity was just too high of a risk. You can't build a business if you don't know which rule book applies.
So Clarity is supposed to end that argument. How? By picking a winner.
By creating a new definition. The Act creates a specific legal category called a digital commodity.
Okay, a digital commodity. What makes something fall into that bucket?
The definition is broad, but essentially it's an asset linked to a blockchain that gets its value from the use of that system. And here's the split. The CFTC gets oversight over these digital commodities.
So they would regulate the exchanges and brokers for things like Bitcoin or Ethereum.
Exactly. Which makes sense intuitively, right? Bitcoin feels more like digital wheat than a stock in a tech company.
Yeah, it's a resource you use to pay for block space.
That's the logic. The SEC keeps jurisdiction over assets that are clearly investment contracts, things that look and smell like stocks.
Okay.
But the CFTC gets the bulk of the decentralized market.
Okay, but here's where it gets really interesting for the tech crowd. I was reading about this certification of decentralization. That feels like a completely new legal concept.
It is the coolest detail in the bill, legally speaking. It acknowledges that crypto projects evolve.
Evolve how?
Well, a project might start out looking like a security. You have a central team, a founder, they raise venture capital, they build the software. At that stage, it's a tech startup.
So it should be regulated like a stock.
Right, because you're trusting those founders.
Yeah.
But over time, if they do their job right, the network launches. The community grows, the team steps back, the code becomes open source, it becomes decentralized.
And this act creates a mechanism for that.
Yes. A project can file for a certification of decentralization.
So it can transform. It can graduate.
Exactly. If they can prove the network is mature and sufficiently decentralized, meaning no single entity controls it, it sheds the security label and becomes a digital commodity.
That is massive for developers. Before this, you were stuck in limbo forever. Once a security, always a security.
And that's why this is such a big deal. It provides a pathway. It incentivizes organic growth. It tells founders, if you build a system that runs itself as a public good, we'll stop regulating you like a centralized corporation.
Okay, but let's play devil's advocate. Whenever Congress tries to regulate tech, people get nervous. We have this myth versus fact document from the Senate Banking Committee.
Dated January 13, 2026.
Yeah. It addresses some pretty specific fears, and I think we need to go through them because our listeners are likely skeptical.
And they should be. The crypto community has been burned before. These are valid fears.
Let's hit a few. Myth number 1, this lowers standards. The argument is that moving things to the CFTC is just a way to dodge the strict rules of the SEC. Regulation light.
The committee is very firm on this. They state flatly that's false. The bill actually imports long-standing securities principles into the CFTC framework. But more importantly,
Fraud is still fraud.
fraud is still illegal.
Yeah.
If you lie to investors, if you manipulate the market, you're still going to jail. It just clarifies what isn't a security.
Okay, myth number 2. This puts the financial system at risk. People are worried about another crash bringing down the banks.
The counter-argument here is really interesting. The document argues that the lack of regulation is the real risk. They point explicitly to FTX.
Right.
They say this bill is designed specifically to prevent a future FTX-style collapse.
Because FTX happened in the shadows.
Right.
An offshore exchange with a zero oversight.
Exactly. FTX happened because there were no guardrails. This bill enforces clear guardrails: customer asset protection, segregation of funds. The argument is, if you want safety, you need rules. You can't just close your eyes and hope it goes away.
Now, this next one is the big one for the engineers listening. Myth number 3. The bill criminalizes code. There's this deep-seated fear that if I write software and someone else uses it for something bad, I go to jail.
And this is crucial. The bill explicitly protects software developers. There's a key quote in the document that every developer should hear.
What is it?
Code is protected. Misconduct is not.
Code is protected, misconduct is not. That's a powerful distinction.
It's a vital legal distinction. If you're a developer publishing code to GitHub and you do not control customer funds, you are not a financial intermediary. You're not a bank. You're just writing speech, essentially.
That also protects self-custody, right? The idea that I can hold my own private keys.
It does. The bill preserves the right to self-custody. You can hold your own keys, be your own bank.
But what about DeFi? Decentralized finance? If I have a trading protocol that runs itself, who is the intermediary?
That's where the nuance comes in and where the debate is still pretty heated. The bill requires centralized intermediaries that interact with DeFi to have risk management standards.
So if you're a business using DeFi to offer a service, you have rules.
Exactly. But it attempts to protect the underlying lawful software development. It's trying to thread a very difficult needle stop money laundering, but don't ban the technology itself.
So genius is the foundation, the money. Clarity is the market structure, the assets. Now we have to talk about the third piece of this puzzle, the one that feels a lot less pragmatic and a lot more heated.
The Anti-CBDC Surveillance State Act.
Even the name Surveillance State Act, it's not subtle. You don't name a bill that unless you're trying to make a very clear point.
No, it is not subtle at all. This is the ideological battle. The other two bills are about how to regulate. This one is about what we value as a society.
First, define a CBDC for us. We hear the term constantly.
Central bank digital currency. This would be a digital dollar issued directly by the Federal Reserve.
Not like a stablecoin.
No. A stablecoin is private money backed by dollars. A CBDC is a direct liability of the Fed. It's the government's digital cash.
And there are two very different ways to look at this depending on your worldview.
Correct. The pro-CBDC argument is all about efficiency. They say, look, the current banking system is slow. A CBDC could offer faster payments, lower fees, financial inclusion.
Better monetary policy control for the Fed.
All of that. But the anti-CBDC crowd, they see something very, very different.
They see an Orwellian surveillance tool. That's the language used in the debates.
It is. The fear is that if the government controls the digital ledger, they can see every single transaction you make.
Yeah, potentially control it. This is the programmable money idea.
That is the core fear. The idea that the government could say, you can't spend this money on steak because of your carbon footprint, or you can't buy ammo, or you can't donate to this political cause.
If the money's programmable by the state controls the spending.
So what this act actually does is it prohibits the Fed from issuing a retail CBDC directly to individuals. It bans the Fed from becoming your retail banker.
It effectively kills the digital dollar before it's born.
Unless Congress authorizes it. The bill says any future CBDC would require explicit authorization from Congress. It stops the Fed from doing this as just an administrative action.
And unlike the bipartisan love fest for the Genius Act, this one was a nail-biter, wasn't it?
Oh, very close. It passed the House 219 to 210. This is a sharp split. It's a clash between those who prioritize privacy and freedom versus those who want government-led digital innovation to compete with, say, China's digital yuan.
It's fascinating. The same technology of blockchain can be used for total freedom or total control.
That's the paradox, isn't it? The tech is neutral. These laws are just deciding who gets to wield it.
So if we zoom out and look at all three of these together, Genius, Clarity, and Anti-CBDC, what is the story they are telling us about America in 2026?
The story is that the Wild West era is officially over. We're moving into a structured environment. Genius fixed the payment layer, making sure the money is real.
Clarity is fixing the market layer, making sure investments are fair.
And the Anti-CBDC Act is defining the boundary between state power and private money.
It feels like the U.S. is trying to have its cake and eat it, too. They want the innovation, they want the safety, but they want to keep the government out of your wallet.
That's a good way to put it. The certification of decentralization and the code is protected. Clauses in Clarity really suggest that the U.S. wants to keep this innovation on shore. They realize that if they didn't act, all this tech would just move to Europe or Asia.
It's a bid for national competitiveness.
It is.
But if we connect this to the bigger picture, there's a fascinating contradiction here. And this brings us to a really provocative question that I think our listeners should chew on.
Okay, lay it on me.
Think about it. If the Anti-CBDC Act blocks the U.S. government from creating a digital dollar, but the Genius Act legitimizes private stablecoins that are backed by dollars, what are we actually doing?
That is the billion-dollar question.
Are we effectively privatizing the future of the U.S. currency?
It's a profound shift. We might be moving toward a world where the future of the U.S. dollar isn't run by the Federal Reserve's technology, but by private companies, Circle, Paxos, whoever, issuing stablecoins, regulated by these new laws.
We're outsourcing the digitization of the dollar to the private sector.
We are.
Wow. So the money in your digital wallet is American, but it's not government. That is a massive shift in how we think about sovereignty and money. It's almost like the return of the free banking era, but with digital rails.
It is, and it's happening right now, this week in the Senate. The architecture of the next century of finance is being poured into the foundation.
Well, on that note, we're going to leave you to think about who actually owns the future of money. It's not just a technical question anymore, it's a political one. Thank you for joining us on this deep dive into the Clarity moment. We'll be watching the Senate closely.
Stay curious.
See you next time.